Where should trading be avoided? Identifying dangerous zones, tight ranges, the middle of the range, and bad market timing. Everyone asks where to trade, but the real edge starts with knowing where not to trade. A lot of traders don't struggle because they lack a strategy, they struggle because they trade everywhere at any time without filtering the market. That's why the places experienced traders deliberately avoid often look like perfect entry points to beginners. And if the goal is to build a coherent trading system, that clarity matters, because knowing exactly where trades should never happen is just as important as knowing where to enter. The first 25 seconds. A lot of trading problems start long before the entry, when trades get taken in the wrong places and at the wrong times. That's why the areas professionals deliberately avoid often feel exciting and tempting to new traders. And if the goal is to build a serious trading system, it can't just define where entries happen, it also needs to make it very clear where staying out matters more than getting in. Why saying no matters. Professional trading comes down to selectivity. Instead of trying to engage with every move on the market, the focus stays on identifying the few situations that actually offer real opportunity and letting everything else pass. When losses start to add up, the cause usually appears long before the entry itself. Most damage comes from trades that never should have existed in the first place. Trades taken in markets with no clear direction, weak structure, or timing that simply doesn't support a clean decision. Learning when to say out becomes just as important as learning when to get in, because avoiding the wrong trades often protects the account more than chasing the right ones ever could. Tight ranges when the market has no breath. The first dangerous zone appears during tight ranges with very low volatility. Price moves back and forth inside a narrow space without forming any clear direction or momentum. Several signs make these ranges easy to spot. Candles stay small and cluster together with short wicks. Higher highs and lower lows fail to form, and breakouts appear on both sides of the range but fail repeatedly. Trading in these conditions creates constant problems. Stop losses sit too close to price and get hit by minor noise. False breakouts happen over and over, giving the illusion of movement before price snaps right back into the range. Risk to reward also collapses because the market offers very little room to move while risk remains real. A simple rule helps avoid this trap. Skip trades when the height of the range falls below a defined minimum, such as a few multiples of the average hourly or daily range. The middle of the range, the market's no man's land. The second dangerous zone sits in the middle of a clear range, far from both support and resistance. This area looks calm on the chart, but trading it carries hidden risk. The main issue comes from distance. A logical stop loss ends up far away, while the next support or resistance level sits uncomfortably close. Risk to reward breaks down, forcing either an unrealistically tight stop or a weak profit target. Positioning also loses clarity. The trade doesn't align with buyers at support or sellers at resistance, leaving no real edge. A practical system rule solves this problem. When price sits clearly in the middle of a range, away from both the low and the high, skip the trade even if a signal looks attractive. Bad market timing, when structure looks right but time is wrong. The third category of dangerous conditions relates to timing. A clean level can appear on the chart while the market itself simply isn't ready to move. Common examples include the late stages of trading sessions when liquidity dries up and spreads widen, the minutes before and after major economic news for systems not designed for news trading, and low volume hours that vary depending on strategy and market. These periods increase risk for several reasons. Low volume leads to unstable price and random spikes. Around major news, price often ignores normal technical behavior and produces sharp whipsaws. Order execution can also suffer from slippage, disrupting risk control. A clear rule belongs in the trading plan. Avoid opening new trades during defined time windows before and after high impact news unless the system specifically targets news-driven moves. Turning these filters into system rules. Non-trading conditions deserve a clear place inside the trading plan. That starts with defining what a tight range means, using objective measures like range height or volatility instead of relying on gut feeling. From there, entries get limited to areas near key structural levels, not the empty space in the middle of a range where price has no clear advantage. Time also needs rules, which means setting specific windows where trading stays off limits, such as before major news, after news releases, or during low volume sessions. Once these rules are in place, the system stops relying only on entry signals. It gains a powerful level of protection that defines where trading should not happen, and those filters often make the difference between an account that chops sideways and one that grows steadily over time. A strong trading system includes clear rules for action and equally clear rules for staying out, because capital protection depends on both. With that in mind, think about your own trading and identify the market zones or conditions that deserve a firm do not trade rule. Share one personal example in a single line for us.